What is LMI? Is what we're talking about today in the eCentral Business Show. I'm John Nayler. I'm joined by a resident expert mortgage broker, Laura Sillano from Pod Financial.
Awesome. I love being an expert. That's just tops.
We're talk about where you've been recently on holidays there. Now, is this advice?
No, it's not advice.
Come on, just a little bit.
No, sorry, not advice. To give advice, I need to speak to the person directly. Yeah.
Okay. All right, well, we'll get to that maybe at the end. But
yeah.
Anyway, today's question, what is LMI?
What is that?
Yeah.
Yeah. LMI stands for Lender's Mortgage Insurer or Lender's Mortgage Insurance.
Yeah, sure.
Yeah,
and
so
what's the implication? I mean, I understand it's something that comes into a lot of lending type conversations where you're lending money for a mortgage. Where does it fit in?
Okay, so it fits into the space where the lender can't give you the money without it. So it's basically what it is it's a body that insures the lender against risk of the borrower defaulting. Mm-hmm. So if the borrower defaults on their loan and the property needs to be sold, then the lender's mortgage insurer will insure the bank against the risk of losing money in that transaction. Okay. So it's actually why would a person want it? Because it can be quite expensive and difficult to obtain, because they need it for the transaction that they're wanting to do. So the lender's LMI is actually an enabler to allow people to get into a property or into a transaction that they wouldn't be able to do unless the bank could insure that risk.
Because let's go through a scenario where it kicks in. So I go out and find a property that I'm interested in.
Yeah.
I go to the bank and say, this is my dream place.
Yeah.
And they say, oh, that's great, but we can't quite support that, because it's something about 80% or 90% land or something like that. Yeah,
so it's out of their capital reserve ratios. So that means, in very, very basic terms, it means that for every dollar that they lend out, they need to hold a certain amount of security. And if they don't, then they can't give you the money. They actually can't give you the money unless that transaction is insured by somebody else to allow that extended LVR to happen. So in the case of you going out and buying a property, if you're buying something and it's $500,000, if you've got a deposit for $100,000, that's a 20% deposit on the purchase that you're making. Therefore, LMI should not apply.
Okay.
If you're choosing a standard property. If you are coming to me and you're
wanting $1 million.
And you've got $100,000 deposit, that's a 10% deposit, LMI will apply.
Okay.
Yeah, because you've got a limited deposit for that transaction.
Oh, because correct me if I'm wrong, but the bank is sort of saying we're not in a position to take that much risk.
Correct. Yeah. Oh. They can't do that transaction without insuring the additional risk of that transaction. Yeah. Okay.
But then I understand that you end up actually paying that as the borrower.
I know. How unfair.
So the bank's saying, well, we'll lend you the money if you pay for this risk,
Yeah, but because it's your transaction. So it's the thing that you're wanting to do. The bank's not saying to you, you must go do this. They're saying, if you want to do this, then this is the requirement that we have for you to insure that additional risk. And the premium that you will pay to insure that risk is X dollars. You pay it once when you actually go in. It's not something that you pay every single year. It's a single transaction at the time of purchase.
Okay. And around that too, like I've talked to people that like an investment strategy and they say, oh look, I love LMI.
Yeah.
Because I actually put less money into the transaction as an investment. I go, you're going to have to do that one on a whiteboard for me.
Yeah, so what that's about is, that's about people making their own money go further because they're leveraging somebody else's money. Okay, so say for example, again, same scenario, you've got $100,000 deposit and with that $100,000 you can either buy one property that's $500 and not incur LMI, or you can buy two with a $50,000 deposit on each of those properties.
Oh, right.
And incur the
LMI. Get a third one, you can spot you down for a hotel. Oh, this is not Monopoly. This is real life. That's right. Okay, fair enough.
But it's basically about it can be a useful tool for people who are wanting to build a portfolio, and we can help people ascertain how far their money can go, as well as the risk that might be associated with going that far.
Okay, so that's as opposed to like someone starting out. It's probably, and obviously there's a part of a very specific conversation with a qualified professional here about, you know, but it's more than likely if you're starting out buying your first property that you're probably trying to avoid LMI. Generally, I get to say that. She can't give advice.
It would be nice if every single first home buyer who we come across had a 20% deposit. That's really unusual. Really, really unusual. Most of the people that we come across who are buying their first home have a limited deposit, and they will incur LMI. So it's about, I guess that's about having somebody who can explain it to you properly and what it's for and how it works and what the impact on you is. You know, and in the scenario of the investor, that's what you were talking about before, is exactly what we do, is to work through, okay, well, how far can your money actually stretch to help you get the things that you want to get as part of your plan.
Okay, sure. Okay, well, that obviously is part of a very detailed conversation that you'd have with Laura Sillano from Pod Financial, yeah?
Yes.
Now, how do they contact you then?
Okay, so you can contact me on mobile, that's 0422 320 497, or also you can email through to the office, which is home@podfinancial.com.au.
Okay, fabulous. Okay, Laura Sillano, our resident expert on the eCentral Business Show. We'll see you next time.